this is an article in the New York Times. Scare tactics in Greece. There's the headline. It says, as the debt mess in Europe deepens, bankers are pressing Greece's bondholders to swallow big losses. What's happening in Greece right now is actually very interesting, and it's due to the derivatives market. Basically, one of the big issues in the whole European debacle now is credit default swaps. And this should sound familiar because credit default swaps were a major contributor to the crisis we experienced recently, just a few years ago. And these are basically insurance contracts with a few twists. First of all, credit default swaps are not classified as insurance contracts because if they were, then they would be highly regulated, and nobody wants to see that. So they were able to lobby their way out of regulation, able to lobby their way out of certain requirements. They're not viewed as insurance, but essentially that's what these contracts are. The underwriter of the credit default swap receives a fee to protect investors that invest in debt securities. And basically the agreement is as follows. The entity that wants protection pays an insurance company or investment bank to provide this protection, and it pays them a fee to be protected in case a debt security defaults, otherwise known as a credit event. So if the bond does not default, then the entity seeking protection simply loses the premiums. It's like an insurance policy. You just pay the premiums, you don't get anything back, and contract expires essentially. However, if there is a default, then what happens is the entity that bought the protection surrenders the bonds to the entity providing that protection, and that entity pays back the principal that was lost to the investors. So basically, you're protecting yourself against default by making sure that if your bonds have trouble or the entity goes out of business, that you are protected. Now, with credit default swaps, the unique aspect is you don't need to own the security that you're insuring. Okay, so whereas you need to own the house that you're buying insurance on, you don't need to own the asset that you're insuring with credit default swaps. So basically, an unlimited number of participants can insure a single security, which is a dangerous situation because if you have that one security default, then all of a sudden the entity providing this protection has to pay out massive amounts of money to these counterparties. And the fact is, and we've seen it with AIG, there was no way they were going to pay the contracts if defaults did occur over a certain number. And they were fine with this because they knew that they were the biggest and they were going to get bailed out. It wasn't really going to be a problem. So credit default swaps now have introduced this new aspect to the market where investors can benefit if a company actually does badly. And this kind of brings a twisted view of the markets where a good percentage of investors can benefit the worse a company does or the worse a government does. And this is the case here in Greece. It says, leading the charge is BNP, the big French bank, which has been hired by the Greek government to help persuade investors to accept a deal that would cut the value of their investments in half. It says, on paper, this restructuring would be voluntary, and bondholders would exchange their old Greek bonds at a 50% loss for new ones that would mature in 30 years. Ouch. Okay, so they're taking a 50% hit, and now they have to get bonds with a 30-year maturity to replace what they held previously. It says, in theory, such a move would help Greece get a handle on its debt, and that would be good for everyone. Behind the scenes, however, BNP officials seem to be twisting some arms. Now it says, investors who own Greek debt and have bought insurance on it in the form of credit default swaps wonder why they should accept the offer that's on the table. If Greece stops paying after the restructuring, these swaps are supposed to cover their losses much the way homeowners insurance will cover a fire. So now we have this perverse situation where investors are saying, oh, well, no, I don't want to take a 50% hit. I want you to hit me hard. I want it to go down to zero. What kind of environment does that present when investors are like, give me everything you got? I want it to completely get wiped out. So it says the International Swaps and Derivatives Association agrees. This is one of the groups largely controlled by the big banks. It says anyone that doesn't like the offer can walk away. If a payment is missed, you trigger the credit default swap and be made whole. So he says, oh, it's really simple. If you don't like our offer, you can trigger the credit default swap and you'll be on your way. However, what BNP took it upon themselves to do was go ahead and tell investors that their credit insurance may not pay off down the road because after the restructuring is completed, the terms of the old debt might be changed. And it says normally investors would shrug off such an argument, but the warnings from BNP carried weight because one of the officials who was making them, Bella Yang, a BNP specialist who also serves on the International Swaps and Derivatives Association, she says basically they have to determine what a quote-unquote credit event is. And they said the committee will likely rule that a Greek deal would not constitute a default. That is because the restructuring would be, quote, voluntary, and some investors who were counting on their credit insurance would be out of luck. This is such a, like I said, I mean, the perverse is the only word I can think of at this point, because you have this situation where investors bought this debt, and now the bank that's in charge of trying to make them take as big a hit as possible is saying, oh, by the way, that insurance you bought isn't going to pay off. How do you like that? It's just astonishing. According to one of the money managers, Ms. Yang told investors that one potential hitch would be if Greece were to change the terms of its old bonds, and they would require holders to deliver far more bonds to receive insurance they thought they were owed. So now it's just playing both sides of the fence. On one side, it's working for the Greek government, which is its client, which wants it to make investors take as much of a hit as possible, and also it has pressure from the other side because they wrote many of these credit default swaps, and they would have to pay a lot of money if they actually were to default. So what's the happy medium? You just have investors take a 50% hit, convince them that that's most advantageous, and then rule, because she's on this committee, that this would not constitute a credit event. It's absolutely amazing. Is anything sacred anymore? It's unbelievable what's going on here. So now this situation is, I mean, if I were to describe a textbook example of conflict of interest, this would definitely be it. And again, these credit default swaps are mentioned. They're in play. The market is booming. These swaps are all over the place. They're traded over the counter. So to really determine the specific contracts that are out there and who's on which side is extremely difficult. But you know, if you look at any numbers of how many billions of dollars of these CDSs are out there at any particular point, it's simply astonishing. Unfortunately, the legislation that came out after the financial crisis did very little to address this. This market is completely booming, and really, there's not much to stop entities from writing all the credit default swaps they possibly can, whether or not they actually have the ability to pay off in case these credit events do happen. So that was a little bit on the Greek debt crisis and the role of credit default swaps. Once again, they're basically an insurance policy with teeth, whereas multiple entities can insure a single debt security or provide protection against a single event. And that's where a lot of the systemic risk comes from. You have companies that are leveraged, that borrow money to buy more credit default swaps, make more securities out of them, and so on and so forth. And that's why when you have what we saw in the United States, where you have one bank collapse and the next bank collapses because they had agreements to which they were counterparties, and these dollar amounts are so huge that any loss on any one bank can absolutely take the whole system down with it. It's really amazing to see the swaps, which could be used to protect investors and it could be used as a hedging tool, but it's become this monster that's just eating everything around it. So we've yet to see how this plays out.